Richard, a robust speech outlining some of the threats and dangers that we're facing in the insurance industry at the moment. Yeah. Which are the key threats and dangers do you think that are underway at the moment?
I mean, as I said in my speech, there are a few factors, but the reality is 2010 and 2011 are going to be very challenging because we're seeing rates soften, because we're seeing a poor environment for investment returns, and because of the general economic climate where the clients that we insure are faced with pressure on profits, faced with pressure on revenues, and they frankly don't want their costs to go up. But we need the rates to go up because we're not going to see the investment returns come through. And if we have one or two catastrophes in the latter part of this year, that could effectively wipe out all our underwriting profit for 2010.
As you said, a tough year ahead. Given that we've heard a lot about reform as well, how do you think that will fit together?
I mean, reform fits in very neatly, frankly, because reform is around making this market more efficient in getting data moving from the broker to the underwriter in a seamless fashion with a great audit trail and with no rekeying. So that will help underwriters understand the risks that they're taking on, make sure they get the right information and price the risks appropriately. But straight-through processing makes this market more efficient, and we have to do that.
I think the development of the mathematical models by rating agencies, the Solvency II and Swiss Solvency Test, the Solvency II regime will cause reinsurance companies to have a bit more discipline than they've had in the past, and I think we've seen that in this cycle as well. But the other part of taming the cycle really is that when new capital comes in for example, in a post-event context, my guess would be that the next time we'll see most of that capital come in the form of sidecar. Temporary capital will come in. When people invest in a reinsurance company, they get really three sources of risk. They get multiple expansion or contraction, they get the underwriting risk, and then they get some asset risk. And it may be that more investors, when the market is next in a tight phase, are likely to prefer the more pure play offered by the sidecar and cat bonds. So we would not expect a class of 2010, for example, if we saw a big storm in Florida this year. I think what we'd see is a lot of capital coming in into this via sidecars and cat bonds.
Hi, I'm here with Tom Bolt, the Director of Performance Management at Lloyd at the Insurance Day Summit after his keynote speech this morning. Tom, one of the themes of the speech was essentially that the onus would be on underwriters this year to deliver the returns. Why is that so different from previous years, and what are some of the factors behind that?
Probably key is the investment income that has traditionally assisted insurance enterprises in making money is going to be vastly reduced after last year's favorable recovery from the 2008 year. So if many investment analysts are saying you'll get something in the neighborhood of 1.8%, then that's not really a lot to balance out any level of underwriting losses. Additionally, in a number released in other papers today, was about 16 billion in cat losses in the first quarter. That puts us at a very material different position than we were a year ago. So being prudent on your rates and what you participate in the soft market is very important.